Hello and welcome to this week's Market Outlook. This is Jeff Fish, president of MarketGauge.com, and I am filling in for Keith this week. And in this video, I am going to really focus on the fact that while the markets may be, or the media may be focused on the fact that the markets are making new highs and reasons to be nervous, I am going to focus on the fact that really that shouldn't be what you're focused on right now. In fact, the markets are just in a period of complete indecision with a bullish bias, and I'll explain why. But before I do, let's first make sure that if you're just finding this for the first time on YouTube, please know that you can get this on our site as well over at marketgauge.com in the blog and free tools area. You could put /outlook as well. Also, know that you can get even more information from us on a regular basis by subscribing to us on Twitter with @MarketGauge and @MarketMinute. And if you're not already seeing this in HD, use the settings in the lower right-hand corner. It'll make it much clearer. I think you'll like it a lot better. All right, so with that, let's just first start with the four major indexes, what I would refer to as the market watch. And while everybody's focused on the ups and downs of the individual day, I think that's just going to drive you crazy, and it's going to drive you crazy, I think, for a really long time. And I don't think it's really worth paying attention to until the IWMs down here in the lower right-hand corner break out to new highs, until the SPYs really break out above this level to new highs and close there and then continue higher. It's not a one-day big breakout thing. The Qs are just on a steady track higher. All right, and the Dow, that too as well, needs to break out to new highs and continue. Until then, you really just need to, I think, should expect that the market's upside trajectory is really going to be a mess. And the time where you have to start worrying about it being a problem, I don't think you should worry about it until the SPYs break down below this level of support and the 50-day moving average, until IWM breaks below its recent lows. Say the same thing about the Qs, and same thing about the Dow in the lower left-hand corner. And I would also say for the Qs, there really isn't a big number to be focused on until you get all the way down to 121. So if you're in any of our members groups where you get my weekly trade plan video, none of this is going to be new news to you. If you're not, and you're looking at these charts and saying, wow, that's an awfully wide range, how are you going to trade that? I think we have a situation right now, and I'm going to show you why when we get to the other parts of the video here, where the bulls are afraid of what the Trump administration is going to say next that's going to spook the market. And the bears can't really get a hold of this market, because what if Trump's fiscal policies or what he's projecting actually comes true and growth really accelerates, and then the bears are going to be in trouble, right? So everybody's kind of on pins and needles. So rather than subject yourself to pins and needles, widen out your viewpoint. Know that the market's going to be choppy, even if it starts to trend higher like the Qs. So if the markets do break out here, I wouldn't expect that we're just going to accelerate higher and it's going to be a melt up. Because of what I just described, and because of the industry group and sector rotation that's going on. And I'm going to point that out in Little Big View in just a second. I would more expect that you're going to find a choppy move higher like we've seen in the Qs here. It could be steadily higher, but it's going to be choppy. So that's perfect opportunity for those of you who understand the opening range and how to buy dips. For those of you who are following Mish and you understand how to buy the changes in momentum in the trend. We did a webinar on that earlier this week. So if you didn't participate in that, there'll probably be a replay out this weekend. So but before I leave these charts, let's just not get too excited about either a big breakout or even a big sell-off. The market sells off big on Monday or Tuesday. Like I said, until we really break down through those 50-day moving averages and the consolidation areas, it's just choppy consolidation because both sides of the market are on pins and needles, courtesy of President Trump. So why do I say that? How can you monitor that going forward? Well, let's take a look, as Keith usually does, and we would encourage you to, at the Little Big View product. All right, now in market overview, I just want to point out one quick thing. We had what I would describe as pretty strong employment data today, and yet with the exception of the Dow, really not a whole lot of volume to the upside. We moved up, got an accumulation day, great. That's all bullish, but it really wasn't that much of a day. The numbers were nice, right? The Dow up 180 points. Strong day on the percentages for the diamonds and for the Russells, and we really would like to see the Russells to get back on track. But hey, give them a break. They were the strongest coming out of the election, and now they're just taking a little bit longer to consolidate. So all in all, a solid day, but that's about it. Key thing to remember is that year to date, and this will mean a lot more to those of you who are part of the January trend trade, year to date, things are on the right track, moving higher. And for those of you who follow the January trend trade, you know that the further move higher just potentially accelerates in those particular areas. Let's go take a look at the sector summary, because this is really where I think the key is for figuring out where this market's going to go next. All right, now I'm sorry this image isn't showing up in my browser. Sometimes it shows, sometimes it doesn't, but that's not the key of my point for you today. The thing I want to point out is the power of this particular table for you. All right, and especially powerful right now. And I say that because it wasn't too long ago, or at least it doesn't feel too long ago, where all these phases were bullish. And we had a pretty much uniform 6-month change, which was all bullish. The reason that this is more powerful now, and this is the reason that the markets are easily perceived as being difficult and choppy, is because we've got a lot of cross currents. Right? We don't have really strong trends right across the board. We've got 2/3 of them are positive over 6 months, but another third of them are not just negative, some of them are pretty strongly negative. Now, we might argue that that's actually a good thing, but what that does do is it dampens the volatility, for one. It dampens the potential for the market to just accelerate incredibly to the upside. And I would also say it's going to dampen the fact that the sell-offs are not likely to turn into a cascade until these really strong movers up top here really do break down. All right, so keeping an eye on these phases, for one, looking for the things that have pulled back, and make the assumption that if they've pulled back to these major moving averages and they've got some support, that there's a good chance that despite the fact that the market may feel choppy, that this is all part of it. And so opportunities to get into swing trades when the choppiness brings stuff back to their major moving averages, like the 50, like the 200. And even if we find some of this stuff down here, maybe we'll get into charts later, but some of this stuff like healthcare, changing into an accumulation phase, this is coming up on a 200-day moving average. If it pulls over that 200-day moving average, it could look like it's had a fair amount of time in its base, and it could break out, and that could be what continues to fuel a slow grind higher. All right, another place to keep your eyes on is the consumer discretionary. The chart there looks pretty good in terms of a pullback to prior support. It's in a bullish trend. So keep your eye on this, and if this market does break out, then slowly this will start to become greener and greener. If you're thinking the market is overbought, this is probably the best reason to say no way. All right, everything is not in a bullish phase. everything is not overwhelmingly bullish. On a 6-month basis, you can see the same thing. Now, the flip side of that, the other reason this table is so powerful right now is this column right here, year to date. So anything that right now is negative for the year is clearly underperforming, and that's not where I would go looking for shopping ideas for the bulls. All right, XRT negative for the year. If you want to play for the consumer, then focus on XLY. It's bullish, as I just said. The chart looks pretty good, and it's got pretty good numbers across multiple time frames. All right, so you want to keep your eye on the year-to-date column. Be warned that anything that turns red in this year-to-date column is the stuff you really want to stay away from and get away from it quickly. All right, so don't ignore this table. It really is a powerful table, especially as I said right now. I think this really describes why the market's so choppy, why even a move higher in the market is going to give you time to buy pullbacks. Don't have to worry about it running away from you. So let's take a look at the hotspots, so to speak, in the market, because there's some interesting stuff going on in here. One, sugar. All right, now I say that because I know what the chart looks like. It looks like a very interesting potential breakout here. Nice big day today. That's why it got flagged. Regional banks, look, it's back into a bullish phase, but both the banks and XLFs rallied smartly today because of Trump's comments about wanting to put a serious review on the Dodd-Frank legislation. These things are just in a really strong phase, a really strong market. They may have come back over their 50-day moving average. That's why you get this highlighted resumption of the bullish phase here. But let's see if they can continue. The other thing that's interesting here is Gulf, right? So, with all the rhetoric and even today threatening more sanctions on Iran, the Middle Eastern ETF here is doing quite well. Now, it's not very liquid, but if you take a look at the chart, it's actually doing quite well. Doesn't really represent what you might think if the rhetoric coming out of Washington was going to incite more global instability. All right, now, don't take me wrong. I don't like everything that comes out of Washington with respect to our international policy, but this isn't about the politics. It's about looking at what's being said and looking at what the markets are doing as a result. If we come down to the 6-month leaders, you see that it's really just, I would say, more of the same. All right, the banks and semiconductors in the bullish phases. Energy struggling here, but energy really is kind of stuck in a funk. All right, now let's take a look at the market internals. These two support what I am saying, which is the markets right now are not overbought as much as it would be easy to say we're at new highs, we're breaking out. The internals here, the up-down volume ratio, the McClellan ratio, is just stuck in a range. It's grinding just like the market. It's neither bullish nor bearish at this point. I wouldn't read into it. I wouldn't make much of it until it gets over this level or down under this level in pretty much every single one of these. I might be a little more cautious. I would be a little more cautious if they were to all kind of turn down and get below the halfway line. All right, this advanced declines 10-day here hasn't been over the zero, hasn't been under the zero line. So if it got under there, I'd be a little more concerned. But I already told you that I wouldn't really be concerned until we see a break of the 50-day moving average. I just wouldn't try and figure anything out between where we are now and that low. I think you'll drive yourself crazy. If we look at the Qs or NASDAQ, it's pretty much the same thing. All right. Internals stuck in the middle, stuck in a range, and despite that, you can see that the markets have ground higher. So what's that telling you? It's just not overheating. And if you want to try and pick a top, the best time to do that is when you've either got a severe divergence, which we don't have, or a potential blow off in terms of these sentiment ratios. If we look at the new highs, new lows, it's healthy. All right, you've got over 100 on good up days of just pure new highs, and your ratio is up over the 85 level. I wouldn't look any more into it than that. If it's over 85, it's bullish. Doesn't really matter what direction it comes in. If you start trending down, getting closer to 70, then it's a negative. If it gets under 70, then it becomes even more negative. If we look at the Qs in the same way, or NASDAQ, I should say, same thing. Grinding higher, this is still up here in positive territory, and these numbers are relatively healthy, over 100. I wouldn't read any more into it than that. It's not overheated, and it's not a major divergence. In terms of the volatility, I actually think that the reason volatility can't get out of its own way is because of what I've said earlier, that the industry group and sector rotation is a healthy condition that's preventing the market from getting too overbought, and it's also preventing the market from really running away in a melt-up like fashion. So I wouldn't pay any attention to this until it gets to one side or the other of the band. And finally, the last volatility measure is stock, again, in a range, neither way overbought or oversold, hasn't rolled over. So at the end of the day, you want to just keep an eye on these big levels and don't overthink it. All right, don't overthink it. Now I'm going to leave you with a couple of charts to keep an eye on that will put a little bit more of a global perspective on this. First of all, if there's one country that should be really hurt as a result of all the trade rhetoric that's come out and even just building the wall, right? Mexico. Yet look what Mexico is doing right now. It doesn't, I can't imagine that the news could have gotten much worse at this point in the game for Mexico, and yet it's rallied. It's coming back to this major inflection point. Now, I'm not saying it's that this is the time to buy Mexico for everyone, but if you're looking for a kind of a barometer of how the market's really feeling about Trump's protectionism, Mexico would be one place that I would look. And again, this isn't trying to evaluate what Trump is saying. It's evaluating how the market is really interpreting what Trump is saying, and that's more important. Here's the key line in the sand for Mexico, this 46 level. It's just come back over the 50-day moving average. Nice consolidation. We kind of talk about this in the webinar that Mish did this week. So again, if this is of interest to you, how to play these kinds of things, make sure you see that webinar. And you have to see it this weekend. And the other one to keep an eye on, again, related, is EEM, right? So EEM is emerging markets. And if there was one place that we would expect to see really getting hurt based on the rhetoric coming out of Washington with respect to all the protectionism, it would be emerging markets. Now, they got hurt, as you can see, right after the election. But since the lows in December, they've actually outperformed the overall market. So I'm going to give you they've outperformed the developing markets and the U.S. So I'm going to give you a little sneak peek here of some product development stuff that we're working on that I think you're really going to like. It's the new Big View, and one of the views in the new Big View is this one that you see, where we're looking at EEM, how it's performing, show you real motion on it, but I'm not going to talk about that right now. I want you to see the EEM relative to the SPY. So when the red line here is over the black line on this ratio, the EEM is outperforming. You can see the EEM has outperformed the SPY since the beginning of the year. And it's also outperformed not just the SPY, but if we look at the EEM versus the developed markets, it's hard to see down here, but you can see it has been outperforming there too. So what's my point? If the emerging markets aren't afraid of Donald Trump, then our markets really aren't that afraid of Donald Trump either, or that's how I would look at it until the markets tell you otherwise. All right, so don't get all wrapped up in the banter of what's coming out in the news. Just focus on the charts and focus on those industry groups and sector rotations. All right, that's where you're going to be able to find the big opportunities, and that's what's going to keep this market grounded, at least for the near term. All right, hope that helps, and I'll see you in the next video.